Hello, ladies and gentlemen, Greg Michalowski from ForexLive.com. This is a Forex Quick Look. We're going to take a look at the dollar versus Canada. Today's day is May 3rd, 2024. Let's get started. The dollar versus Canada was sitting near the 50% midpoint of the April trading range, just ahead of the U.S. jobs report. Then the jobs report came in weaker than expected and sent the price sharply to the downside. That moved to the downside, moved to a swing area where we had a number of different swing highs forming this ceiling through here. And it stayed that ceiling until we broke above here and then failed quickly and then reestablished the ceiling, moved lower before finally breaking here and then moving to the upside through there. So strong ceiling through here becomes a floor right here and trading here today, and the price bounced off of that level. Later at 10 a.m. we had the ISM non-manufacturing data come out, and that showed that the prices paid component of it was better than expected, much higher than expected, 59.2 actually versus 53.4. That kind of put the spook on the market, and we've since seen a rotation back to the upside. We got above the 400 bar moving average on the 400 bar moving average on the 4-hour chart. We also got above this swing area in the 50% retracement level. So the sellers turned to buyers quickly. But where did we stall? We stalled right against the 200 200-hour moving average. Recall from yesterday, the price fell below that level, and also these other moving averages increasing the bearish bias into the close, moving back down toward that 50% retracement level. So where do we stand now? Well, we had, what do we do today? Well, we found support right near the where we'd expect to see support against this old swing ceiling area right through here. And we were also finding resistance against a key moving average up through here. Admittedly, we moved back above the 50% retracement level. So, if you were to give a bias tilt, the sellers had their shot. It seems like they missed with the price moving back above the 50% retracement level. That doesn't necessarily mean that we're going to stay above that 50% retracement. It just means that we have to get back below that level. The sellers have to prove that they can get below that 50% retracement level and stay below that level, and then start to work at the other levels on the downside. So unfortunately for the sellers off of the U.S. jobs report, it hasn't worked out the way they thought, at least in this currency pair. Nevertheless, the technical levels are defined with the 200-hour moving average on the top side, the swing area on the downside, and the 50% retracement in the middle, defining the key levels going forward. My name is Greg Michalowski. Good fortune to your trading. Bye-bye now.